Thanks for joining me for part 2 of the Chapter 2 sample problems. Next, we are going to look over an example of a trial balance. Again, if you have not watched the MyLab video on what a trial balance is, there's a short video out there that walks through what this is. Basically, the trial balance is the summary of all of the list of accounts and what their ending balances are as of the end of the financial statement period. So we're going to look through our list of accounts, and the trial balance does need to be in a particular order. Typically, it is in an order that is similar to a balance sheet, along with the revenue and expense accounts at the bottom. Okay, so what we're going to do here is we're going to put these in order. We're going to have our assets first, short-term and long-term. And we're going to have our liabilities, short-term and long-term. And then we're going to have our equity accounts. So capital, withdrawal, retained earnings. And then we're going to have below that our revenues and expenses. Okay, so that's the general order we're going in here. And then as far as short-term and long-term, anything that is expected to be due or used up, etc., in 1 year or more. So 12 months or more is what differentiates long-term versus short-term for accounting purposes. Now, assets are typically listed in order of liquidity. What that means is that how close are they to cash? So cash is the closest thing to being cash because it's already cash. So that will always be the first asset that you'll have listed there. And remembering from our previous problems, the normal balance for an asset account, so the normal balance is whatever direction debit versus credit will increase an account. All right. So an asset, the normal balance is a debit. For liabilities, it's a credit. For equity, any account that increases equity, it's going to be for a credit. And any account that decreases equity, like a withdrawal, oops, sorry, that should be next to the withdrawals there, not next to the retained earnings. I'll move the retained earnings here. Okay, so retained earnings is also going to be credit, normal balance. Withdrawals, the normal balance would be debit, and then expenses, again, the normal balance would be debit. All right, so going back to our trial balance, we've got cash. Let's look through here and see what other assets might we have here. So unearned revenue, we discussed that in an earlier problem. That means that someone has prepaid us and we have not delivered to them. So we owe them delivery or performance. So that's a liability. So let's just go through here really quick and label all of these. So we've got asset. This is a liability. Equipment, that's an asset. Revenue, that's an equity. Capital, that's an equity. Expenses affect your equity, equity, equity. Accounts payable, that's a liability, requires future use of resources. And then withdrawals, that's a reduction in equity there. All right, so now that we know what all of those are, we can put our assets first. So cash is short-term, got that one, $7,000. And then the only other asset we had listed here was equipment. All right. Looking for liabilities, the only thing we have here is that unearned. Oh, yeah, no, we've got accounts payable here. Whoa, I scrolled it. There we go. We've got accounts payable and unearned revenue. Typically, accounts payable is listed as the most immediate liability because we've already incurred that and it needs to be paid at, at the earliest convenience. So that's going to require the most immediate use of cash. Unearned revenue, someone has paid us cash and we actually have to perform in order for that to relieve the liability. It's not just a payment, and it's still short term because normally when people pay us, they expect a relatively near-term performance, less than a year. But it takes more to relieve an unearned revenue than an account payable. So we're going to put that below, also a liability. All right, so those are our two liabilities. Then everything else we had was equity. So we're going to look here then. We're going to want to put capital accounts first. So kind of that same order that we normally have our equities. So capitals, withdrawals. If we had retained earnings, which isn't listed on here, we would put that next, then revenues and expenses. So we've got Cooper Furniture Repair and Cooper Capital is our capital. And then we've got Cooper withdrawals there that I see. So this increases equity. So it's going to have a credit balance for the Cooper Capital. And then the withdrawal reduces equity. So that's going to be the opposite direction. So we've got that. So we've got those two out of the way. Next, then we are going to look at revenues and then expenses. So we've just got our service revenue here. Revenues increase equity, so therefore it's a credit. And then we've got our three expenses: advertising, rent, and utilities. Let's see, and does it say anything about order on those? It does not, so I'll just go advertising, utilities, and rent, just like they have it. And those are debits, they reduce equity, so and then we need to add up each column to make sure that they are equal to each other. So I'm just going to do this really quick. That gets me 27,000. All right, I'm going to double check. My debits should equal my credits because this is a trial balance, which means it balances just like our accounting equation. All right, 27,000, looking good. So let's check our answers. All right, looks good. So that is problem 4. All right, so our next problem, problem 5 here, is related to a ratio. So use the following accounts and their balances. Calculate the debt ratio for Cooper Furniture Repair as of December 31st. Once again, want to make sure you've watched the MyLab videos so that you understand that the debt ratio is basically telling us what is the relationship between our total liabilities and our total assets, right? So hopefully we have fewer liabilities than we have assets. So what we need to do here then is figure out which of these are either assets or liabilities. So just like in our previous problem, cash is an asset, unearned revenue is a liability, equipment is an asset, revenues, equity, this is equity, 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 liability, and equity. So those are the only 4 accounts that we care about. So for liabilities, we have 4,500 and 2,300. So 6,800. And then for assets, we've got 7,000 and 10,000. So total of 17,000. So then we're going to figure out what percentage is that. 6,800 divided by 17,000 gives us 0.4. So this is a decimal format, right? Oops, that shouldn't have gone there, but a decimal format. So we need to make sure that we convert that to a percentage. So this should be 40% here. So 0.4, multiply it times 100 and put a percent symbol next to that. All right, Now, this last problem is a little bit of a bear. It's kind of long and involved, and it involves journal entries and some T accounts and a trial balance. So this is one that would be, I'm going to kind of zoom through this, but hopefully you will be able to think about these and enter them kind of at the same pace that I am putting them in there. I'm going to go through these without explaining as much because this is summarizing stuff that we've already talked about here. Okay, so here we have a trial balance as of March 31st of 2024, right? And so this is the starting trial balance for this company. And then they, during April, are undergoing a bunch of transactions, okay? So first, we're going to record all of these transactions through journal entries. Fortunately, there's not that, oh, how many do we got? I guess there's a list. They don't have them all listed on here. Okay, they're just going through them in here. So we're going to journalize a number of transactions. We're going to put them into T accounts, and then we're going to prepare the trial balance. So I'm just going to read these and then do the journal entries as we go. All right, so we're borrowing $45,000 from the bank and signing a note payable in the name of the business. So we are going to receive cash that we are borrowing, debiting cash, and we are going to owe a note payable for the same amount, right? And then we are going to show that we borrowed cash on a note payable. Next transaction, paid cash of $40,000 to acquire land. So we're increasing our land asset, decreasing our cash asset, debiting to increase land, crediting to decrease cash, and purchasing land with cash. All right, next, performing services for a customer and receiving cash of $5,000. So cash is increasing, that's going to be our debit. And performing services, revenues, so service revenue is going to be our credit. And we are going to say performed services and received cash. All right, now we're going to purchase office supplies on account for $300. So the asset we're increasing is going to be the office supplies. And this is on account. So instead of decreasing or crediting cash, we are going to credit our account payable to show that we're going to pay them later. So purchase office supplies on account. All right, next, perform services for a customer on account, $2,600. All right, so if we're performing services, then they owe us money. So that's an asset for future use. Accounts receivable for $2,600. So we're debiting accounts receivable and crediting our service revenue. Every time I move up, it's scrolling. All right, performing services on account. Next, we are paying $1,200 on account. So we're decreasing our cash. If we're decreasing cash on account, that means that we are paying off part of an account payable. So to decrease an account payable, accounts payable increases by crediting and decreases by debiting. So that's going to be our debit. And then we are going to, so going back here, by the way, we had accounts payable of $2,000 plus the $300 we added to it before. So this is still only paying off part of our accounts payable. And then we are going to decrease our cash for $1,200. Paid cash on account. All right, paid the following cash expenses. All right, salaries of $3,000, rent of $1,500, and interest of $400. So expenses are like assets. They increase by debiting. So we're going to put those first. So salaries expense, rent expense, and interest expense here. And then we are going, and we're paying this, so we're decreasing our cash for the total, so 3,000, 4,500, 4,900 total. And we are paying cash expenses. All right, next we are receiving 3,100 from a customer on account, so we are going to increase or debit our cash. And it's on account, which means that we had performed services for them previously. They did not pay us. So what we're doing is we're reducing the accounts receivable that they owe us and increasing cash. All right, receiving a $200 utility bill that will be paid next month. So increasing our utility expenses. And then we are going to record, since we're not paying it now, we're going to pay it next month. We're going to record that as an account payable. So operating liabilities short term. So received but did not pay our utility bill. Whoops. They put it into utility payable instead of, so they have a subclass, but same concept. All right. Received $1,500 for services to be performed next month. So they are prepaying us, which means that we are receiving cash here. But because we are not performing yet, we owe them future performance. So we are going to have some unearned revenue here. And then, so received, collected cash for future services. There we go. All right, and then we had a good month, so we are going to withdraw some cash of $1,800. So credits increase equity, debits decrease equity. Since we're pulling money out, we are decreasing equity. So this is going to be Harper withdrawals. And then it's going to be a credit or reduction to our cash. All right, so we have done all of these journal entries, and now they want us to put all of these into our T accounts. So unfortunately, this is going to require some scrolling back and forth because we're going to want to check out the dates and amounts that were for each of these transactions. All right, so looking back in order, all right, debiting cash, crediting notes payable for 45,000. All right, so that's our first transaction. Next, we've got debiting land, crediting cash for 40,000. So land, cash, 40,000. All right, that's our second transaction. Next, we've got debiting cash, crediting service revenue for 5,000. Oh, let's see. That was our third one, so it's got to be the 9th, right? Okay. All right. So debiting office supplies, crediting accounts payable for 300. So office supplies, accounts payable, 300. Okay. And then accounts receivable and service revenue for 2,600. Sorry, that was 2,600. And then we've got accounts payable and cash for 1,200. I think I put that on the wrong one. That was supposed to be a receivable, wasn't it? Hold on. This is supposed to be the 1,200. Yeah, I definitely put that under receivable or a payable. So anyway, accounts payable. Sorry, let me go back to that. April 18th, accounts payable and cash. Okay. Okay. And then salaries, rent, and interest. Okay, I'm gonna write this down here. 3,000, 15, and 400. Here. Okay, so salaries expense was 3,000. Rent was 1,500. And interest was 400. Okay. All right, and I'm pretty sure these ones, they only have one line, so I'm adding up the beginning balance plus any activities. This one only had activity here. And okay. The next transaction we had was cash and accounts receivable 3,100. Was April 25th. All right, looks like this one's done. Okay, we'll come back to this in a second here. I'm going to finish the transactions first. Utilities, expense, and payable for 200. It was April 27th. And then we've got cash and unearned revenue for 1,500. April 29th. And then we had last transaction was the withdrawal, which was 1,800. So debiting withdrawal, crediting cash. So that 1,800. All right, so Harper Capital did not change. We can just total all these up now, make sure we've got a balance for everything. Now, all of these where it's all on one side, it's pretty straightforward. You just add it all up. Okay, so this one though, we've got two different directions going on, right? So we started with 4,500, we add 2,600 there. And then we subtract the 3,100 on the other side. So that gets us an ending debit balance. We had more debits than credits. So our ending balance is 4,000. So we got that. All right, here, 15, 17,600. Here we've got 2,000 plus 300 here on, so I'm just going to do 2,000 plus 300 gives us 2,300 minus the 1,200 gives us 1,100 left over. There. All right, now this one's going to be a lot. All right, so I'm going to actually use a little spreadsheet for this one, just because there's a ton of activity here, and I want to make sure that I don't make any mistakes. Do this, right? All right. So that's our total debits. So I'm going to sum that up. So total debits of 78,500. And then for credits, we've got a copy and paste that over. So we've got total debits of 78,500 minus our credits of 43,000. That means we have a net balance here of 35,500. Let me check my math on that. 23,900, 45,500, 3,100, 1,500. All right, so we've got that through A6. All right, and then we've got 45,000, 40,000. Do I have everything on here? 40,000, 1,200. Am I missing something here? Let's double check our, so we've got 4 debits and 3 credits here. So we've got debit, credit, debit, credit. There's another credit. Ooh, I don't think I got that. There we go. 4,900 of cash. I forgot that one. Okay. Let's move these down. 1,800. There we go. And 4,900. See, that was the same date as the salaries expense. So that should have been April 21st. There we go. All right. So going back here then, we've got, all right, so let's try this again. Equals 78,500 minus 47,900. So 30,600. Okay. So if you miss one, you'll end up getting it wrong. All right, so let's do that. Let's check. The odds of a typo here are high. So let's see where we're at. Sure enough. All right, where are we at? Where are we at? Let's scroll through. Wrong date on that one. Okay, what was the date on that 1,800? April 30th. All right, wrong date. There we go. All right. So that's all still up here. Now what they want us to do is assemble a trial balance using all of these end balances. And they were kind enough to put these in order by column. So we go down the first column, down the second column, and down the third column for order. So we're going to need cash, accounts receivable, office supplies, and land. And our balances are going to be 3,600, 4,000. Then 340,000. I'm just grabbing the end balances from up here that we came up with, right? So next we have liabilities, accounts payable, utilities payable, unearned revenue. And then we've got notes payable, Harper Capital, Harper withdrawals. All right, so let's get those. Let's see. So 1,100, 200, 1,500. And then 45,000, 18,500. And then 1,800. Okay. So this is a debit, it's on the left, so it goes in the debit column. If the ending balance is on the right, it goes in the credit column. Next, we've got service revenue, salaries, rent, and interest expense. And then those are 17,600, 3,800. $2,500, 400. Then our last account is utilities expense for 500. All right, let's see. Now we got to add them all up here. So let's delete that out. All right, I'm 3,600, 4,000, 300, 40,000, 1,800, 3,800. All I'm doing is math here to get my total debits and total credits. $83,900. Right, and then let's go to the other side. And it's the same. All right, and so you'll know if you've got it equal on both sides, you probably have it correct. If you add yours up and they're not coming up, then you have one of these maybe on the wrong side. So double check if you've got it debits versus credits. And that is the last sample problem for chapter 2.